Hey everyone, welcome back to Drawbridge Finance. Today I want to talk about selling put options instead of buying stock. As always, welcome back to the channel. My name is Levi Woods. I'm not a professional investor. I don't work in the finance industry, and this is an opinion channel about money. Today I want to talk about going long stock or buying stock or the alternatives to it. And one of the things that I talked about in one of my recent videos was Shopify and how I was bullish on it. And I actually never put in a position on it. And of course, the earnings came out and it's gone up a huge amount. It's up like 20% last week. And I wish I had gotten in. But, you know, those things happen because sometimes we're bullish on stocks and sometimes we're right and we don't buy. This particular stock I was correct on, and on Etsy we're talking about. And for all my patrons, you guys know about this trade already. I've been putting in a couple of different option strategies on Etsy. I currently don't own any Etsy stock, but I would love to. And one of the problems is that when we look at the chart for Etsy, it's actually way too high. If I just quickly pull up a 1-year chart, you can see that this price has just like gone up massively. A year ago, we could have picked up this stock for $30. Now it's trading at $70. I know the market is cyclical, and I know that likely this stock price is going to drop back down at some point. So although I would like to own some, it's just too high a valuation for me to buy right now. So instead, what I would like to show you guys today is a strategy that I did take, which is selling a put option. And what this does is it allows me to collect a little bit of money without actually buying the stock. And if the stock price does come down to a reasonable level, then I can purchase it if I want to. We're looking at a chart that dates back to the beginning of February. And the price has kind of gone up here and we're riding along. And if we look specifically on March 22nd, there was this big down day that happened. Now there wasn't any particular news that came out, but we were trading a little bit downtrending. We had 2 positive days and then there was this down day. And that was the day that I put in this option sell. And if you guys are unfamiliar with selling a put contract, what it means is that I'm going to sell somebody the right to put the stock onto me. So we make a contractual obligation. I collect money for that contract. And at any time, those stocks could be put onto me. That's why it's called a put option. And they could be put onto me for a price of my choosing. Now, on this particular day, we were looking at the trade. We can see the range was between, it opened at 68.97, and then it had a high of 69.25. It had a low of 65.57. When I actually put in this trade, it was trading at $66.18. So it was right near the bottom of that day. And what I decided to do was to just sell one contract. So one put contract is worth 100 shares. So in this case, the strike price that I chose was $60. And you can see on this chart, I've actually drawn this line on here. So that's the $60 strike. And the expiration date is May 17th. So right out here. At that time, it was 56 days out. I'm entering the contract by selling here. And I have 56 days until the contract expires. If the stock stays above that $60 line, the contract expires worth nothing and I collect all of the money, or keep all of the money that I previously collected back on March 22nd. So let's just see how this stock did, like what actually happened. And as we can see, it had a trading range that was pretty expected. We've seen some ups and downs, but the whole time this stock has been out of the money. And that's the term we use for a contract when it's on the right side for us. So in this case, on a put contract, the current price is above the strike price. So that makes this particular contract, the $60 put, out of the money. As time goes by, there's less chance that this stock is going to breach this contract line, which means that the value, because there's less time left, there's less time value, and that just gets less and less and less. So the real question is, how much did I make off of this trade, or how much have I made so far? Well, I haven't closed it yet. I've got a little, I made a post for my patrons that day, and I said, new option trade, Etsy, expected 252%. Now, seems like a huge return, but I'm going to go through this. So going long Etsy. Etsy's down today, and I really want to buy stock, but it could easily go down lower. So I sell a May put option instead. If the stock drops below $60, I could be forced to buy it for $60. That would give me an average price of $57.10. $60 minus the $2.90 I collected today. If the stock doesn't drop, then I just keep the $290 that I collected today. Seems like a win-win to me. Now, of course, this strategy only works if the stock stays at that line above $60 or if it goes up. So I'm bullish on the stock. So let's see what happens in this particular trade. So the trade that day was I was opening or selling short a May 17th $60 put. The stock price was $66.18, as I said, and the opening credit was $2.90. Now, the margin requirement for that contract meant that my margin, but just my margin, went down by $1,000. Now, if you've never traded on margin, it's a way for us to leverage our money and allow us to use the cash that we have to put on trades without having to use the whole amount of the money. So in this case, although if I was forced to buy the trades, it would be a $6,000 worth of stock put onto me. I actually only used $1,000 in margin. And then my total profit in Canadian dollars, because again, I am Canadian, $3.87 would be the amount that was deposited to my account that day, March 22nd. So I collected that money, $3.87. Now, if I kept this right till May 17th and the stock stayed above $60, I would make $6.92 a day. Now, I don't usually expect to hold it to the complete expiration date. I usually only wait about halfway. When there's about 21 days left in the cycle, I'm going to close this trade, or typically I would. In this case, I actually really want to buy some Etsy stock, so I wouldn't mind getting assigned on this. So I am going to ride it right to the end, right through earnings, which are May 8th. So the return on investment would be $387 from this $1,000 of margin, or 38% return in 56 days. So if we calculated that out, the simple annualized return would be 252%. Now the buyout target, and I always put this on here because it's my plan to get out within that 56-day period. Hopefully in the first 30 or so days, that theta decay will happen. The price of the option will contract down, and I should be able to buy it back for $1.33. So what would be my profit on that? Well, if I sold it for $2.90 and I bought it for $1.35, I'm buying low, and I've previously sold it high, and I would be collecting about half of this $387. So just over $3 a day for a trade. And I can put on multiple trades like this in my account, so I can just generate income on a daily or monthly basis. And it's really, I don't have to pay attention to these very much. So let's look at the actual line of what I did. So March 22nd, this is from my ledger. The stock price was $66.18. I minus one option contract. The option price was $2.90. That's how much I collected. It was a credit. This is a single contract play. I was just playing the put side, so there's no combined price. If I was doing a strangle like I normally do, where I have a call on the upside and a put on the lower side, then I would have a combined price in there, adding the two premiums together. But in this case, it's just a single premium. 56 days to expiration. And what did I do? Sell to open one put May 17th, $60. Margin requirement $1,000, and the gain $280, and that's after commissions, and that's in US dollars. So let's look at this chart. What's happened? The stock has stayed above, and we know that if we check the option price now, it's likely down. We're now only, what's the date today? It's May 5th, so we're 12 days to expiration. There's not going to be a lot of value left. Maybe a little bit more value in this just because the earnings report is coming out May 8th, which is next week. If we go to Etsy and here on Yahoo Finance, just go over to options, click on the options tab. And it's showing it in list view. I always look at it in straddle view. Makes a little bit more sense to me. Now, so with the calls are on the left side, and in this case, I didn't sell any calls. So what I'm looking at are the puts. These are from May 17th. And what did I sell? I sold the $60 put. So we look down at the strike price, and this is where the flexibility of options is amazing. I could choose any strike prices. I could have actually sold the 55 put, which would have been an even safer play. Now I wouldn't have collected as much money, and I do want to generate some income, so you want to keep them as tight up as you feel comfortable to. And I use metrics to actually determine what I'm putting in, which strike price I'm choosing. So in this case, I chose the $60 strike. And the current price of that option contract is $1.20. So $1.20 in US dollars. Remember, I originally sold this for $2.90. So if I bought this out today, I would keep the difference. So $2.90 collected minus $1.20 to buy it back. So I would have made $1.70 over the last, whatever it works out to, 40 44 days or something. But I'm going to keep this because this whole $1.20, I expect that on our earnings report, we're going to see the stock bump up. There's quite a few analysts looking at this. There's a buy rating on the stock. There's quite a few hold ratings. There's almost no one looking at selling this. And I think that we're going to see a pop, probably up into the low $70 after the earnings report May 8th. If it doesn't, it's going to retract back, and it's not very likely that it's going to be down below this $60 strike price. And I'm going to collect the entirety of that original sold contract, the whole $387 Canadian that I collected. Anyways, that's how simple selling a put contract is, and it's another way to get long a stock without actually buying it. I hope you guys enjoyed that video. I hope you learned something today, and let's get rich together.